Hello and welcome to hour 3 of this little mini course. The first hour that we went through on Monday had to do with my approach to technical analysis. And then on the second day, we went through some different strategies. And if you missed those, you can go back and look at the recording. And some of you prefer more of a live environment where others prefer to look at it on your own time and in your own time zone, and we can go through different strategies. Well, what we're going to be covering in this last session is support and resistance. Now, before I get started, if you like these courses, if you want me to do more live sessions like this, please feel free to contact me. Either leave a comment on YouTube or Rumble or send me an email. I like to include an email address in every video that I upload so that you can contact me more directly if you prefer that way of doing things, or just go ahead and leave a comment. I don't want to venture outside of the S&P 500 and a lot of the analysis that I already do. I cover some of those things in my online courses, but for the most part, I kind of want to stay on topic. Now, if you have something that goes beyond that and you feel that I might be helpful to you, remember, I'm not a licensed stock market broker or any kind of a financial planner, but I do have a lot of experience and hopefully some knowledge that might help you. But ultimately, all decisions will come down to you. But if you want to talk through something, go ahead and set up a time where we can talk on Zoom, and we'll just see if that can be helpful to you. So you have other ideas that you might want for me to explore in the future, and the possibility of maybe having some one-on-one. I'm always open to those things, and we'll just kind of see how it goes. As I'm getting everything going, my time will be less because I spend a lot of time preparing the videos that I post, and then I spend a lot of time outside of that working on the courses that I teach, and then I'm developing the website and developing the discussion area and the daily videos that I go through that are not necessarily public. And so my time is somewhat limited. Plus, I'm probably on a very different time zone than a lot of you. So we'll just try to work things out the best we can and see what we come up with. Okay, let's talk about support and resistance. And this is one of those areas where, okay, it's kind of easy to explain what support and resistance is when you're going down and prices tend to stop, and then they turn around and start going the other direction. Or if you're going up and prices stop and turn around and start going down. A lot of times you have to think of what's going on behind the scenes emotionally, that there's people that when we're going up, they have a place where they want to get out. And when you have a lot of those participants all wanting to do the same thing at the same time, then it's like the buyers go away and now everybody becomes sellers, and we turn around and start going down. The inverse of that is also true. We get to a point where people are looking at charts. We've got millions of participants that are looking at the same things that we're looking at, and they're noticing where we've been before, especially when we're going down. They're looking at their indicators too, suggesting that, okay, we might be near some kind of a bottom here. Nobody wants to be involved in the market anymore. And so at some point, all of the buyers dry up and everybody becomes sellers. And a lot of times with a little bit of hindsight, we can tell, okay, that was the bottom. Just as an example, we're looking right now at October 2022, almost a year ago now, pretty much 11 months ago, plus a week, where it looks like we probably put in the bottom. You have other people that say, no, we're going to go down and test that. That's what's often meant by support or resistance. Or we may go back and test the high if prices continue to go higher. And just think of the psychology of what's taking place. People are watching things going up and they're getting ready to pull the trigger to get out, or people are watching prices go down and they're getting ready to jump in because they feel that these are good prices and the market is fairly priced. And so that's when we tend to turn around. So even though it's not all that complicated of a topic, it's okay, what do you follow? What's important? And I wish I had a plain vanilla answer for those things, but I just don't, because what may be support or resistance at one point may be irrelevant at another point, and something that we thought was irrelevant suddenly may come into play. And that not only applies to the S&P 500 itself, we might get support or resistance from a different index. Right now, we have the S&P 500 and the NASDAQ 100, and even the NASDAQ to a degree. They're all battling through different support and resistance levels at about the same time. And that's why we use this intermarket analysis to look at other indexes in the stock market. Well, another thing that's really been having influence on the market at the time I record this is interest rates have really been going up, and oil has really been going up. And that, when it starts to go up too far too fast, that can put some pressure on stocks. And interest rates also work off support and resistance, as does oil, as does pretty much any market there is. And so that market may see a shift, and we're over here in the S&P, and we want to know that when that's happening. And just to give you a little bit of a background, for a very short period of time, I did try day trading, and it was the E-mini S&P 500 contract. It was not for me. I know it's for a lot of people. They really swear by it. It's smaller than the big contracts. It's quite leveraged, and you can make a ton of money doing that, but you can also lose a ton of money. For me, it was just the stress of it all. I like the idea of being flat at the end of the day, but you went through hell during that period of time that the market was open. And you're staring at a screen all day, where I'd like to read a book or maybe watch a YouTube video or talk to somebody. And I can still, like right now, as I'm doing this course, over beyond me is another computer where I'm keeping an eye on the market because it's open right now. I'm also keeping an eye on the clock that I can see. And I was able to come back to the same place that I recorded at before, where in yesterday's session, I had to go into a different place because of noise. I don't know if that's going to happen now or not, but up until the time I started, it hadn't happened. So I'm just going to kind of hope that things stay more quiet. And I also remembered to turn on the light this time, since where I'm at, it's late evening and it's going to be getting dark pretty soon. So hopefully that'll help things, even though you probably can't tell because of the same screen behind me. And no, I'm not really on a tropical beach, even though I wish I was. So, okay, let's talk a little bit more about support and resistance here. And I thought I had the laser pointer going, but apparently I did not. So let's get that going again. I just found that to be a little bit better tool for pointing things out as we go along. So support and resistance. Prices move because of supply and demand. And that's really how the stock market works. If you have a lot of buyers, prices go up. That means there's great demand. And as I explain in the basic course that is available here on YouTube, when you have a lot of buyers lining up, you'll have the market makers on the other side saying, okay, well, if you're willing to buy it at 10, are you still willing? And they don't say it like this, but this is how it kind of acts. Are you willing to buy it at 10 and a quarter? Okay, the line is still pretty long to buy at 10 and a quarter. Well, how about 10 and a half? Well, the line's getting a little bit thinner, but there's still people lined up to buy. And eventually, if the market maker says, okay, how about 11? And suddenly there's nobody in line to buy. Well, that means that demand has dried up. But if you look over in the next line, these are people that want to sell. And maybe they're willing to sell at 11. It's like, okay, now that line's getting pretty long. And so the market maker will say, okay, remember, they're taking the other side of this trade. So they're actually competing against you. So they say, well, you were willing to sell at 11. How about, are you willing to sell at 10 and 3/4? Okay, the line's still pretty long and people are still doing that. How about 10 and a half? How about 10 and a quarter? They get back down to 10 and suddenly the line is not there anymore for people that want to sell. Now you've got people getting back into the buy line. Okay, now most of the time these are matched up with each other because you have people that want to buy and sell simultaneously, and that's what makes for an efficient market, and we like that. When we want to get in or get out, we want there to be somebody on the other side of that trade so that we can get in or get out quickly. And that's just a force of supply and demand. And as I mentioned before, there is a randomness to the market. All those people lining up to buy or sell, that's more random. You can't really duplicate that and make it happen exactly the same way that it did before. But there's also a non-random nature, which means there's more of a structure to the market. And I feel that looking at daily charts and doing things on a daily basis and a weekly basis, and even sometimes on a monthly basis, that helps us give a bigger picture. And those things become less random as you look at them on a longer time frame. Now, there are some random and non-random things that happen within the day, and that's what day traders like to capitalize on. And just as a side note, one of the strategies that's often implemented is to go against the trend. And that's what killed me was I wanted to go with the trend, but you get a market that shoots up or shoots down and it hits support or resistance, and then somebody gets in hoping to capitalize on just a small move in the opposite direction. And it's like standing in front of a freight train. Okay, you're not going to stop it. Sometimes you might jump out of the way in time and just to save yourself a little bit, but a lot of times when you're trying to go against the trend, it's going to really end up biting you. So I developed ways to go with the trend, but then we kept hitting this support or resistance levels and then seeing these short-term pullbacks or bounces, and it was just, I just found it to be crazy for me. Now it may be just the thing that other people need and want, and that's fine, but that's how the market works. Just when there's a lot of buyers, prices go up. When there's a lot of sellers, prices go down. And that's not necessarily complicated. That does not necessarily mean it's easy. So when demand is greater than supply, prices rise. You got a whole lot of people. And I use different examples, but every Christmas, there are the hot toys for that year, the hot products to get your kids. And man, they want them. They'll pay almost any amount of money. They'll get in fist fights. They'll start becoming these ruthless people who maybe in real life they're nice and calm and kind of meek, but man, you get in between the toy that they want to get for their kid and that toy and them, and it could get ugly pretty fast. That's because there's great demand. But toys come in and out. There are things that are popular at one point that maybe a year or two later, nobody wants them. So now you have a big supply, but there's really no demand behind it. And so they might lower their prices to try to entice people to buy something. And those are really the forces that play in the stock market. If you think about it, a company like Apple, Microsoft, Google, the big boys, Facebook or Meta, all in any stock that you might own, from day to day, okay, the CEO is still the same. The officers of the company are still the same. There's really maybe no news that came out about that company. They probably didn't report earnings. It's just business as usual day in and day out. Yet their stock price might go up or down, and that's more of a force on the market. And that's another reason why the market wants to be open as much as possible. I mean, that week in 9/11, since this is the week when we commemorate that, the market was closed for a week and the planes hit right before the market opened. And I was watching things at that time. That was a pretty ugly thing to watch unfold as it was happening, as I'm sure many of you probably have your own story about that. Even though I was way on the West Coast and there were no planes falling out of the sky, it was still quite an experience. And, thinking that the first plane was just a terrible accident, and then you had all the cameras trained on the two towers. And then the second plane comes in and then realizing, okay, this is not an accident. This is an attack. But then after that, because it was so close to Wall Street, they shut the market down for a week. And that was pretty crazy. And even when there are major events, they want to keep the market open as much as possible. So all of the news, everything that's known at that given point in time is discounted into the market. And we get enough of a gap from one day to the next because of 24-hour trading. But at least there are forces that are able to react to things as they're happening. So anyway, and that's part of supply and demand. So when supply is greater than demand, prices end up falling. So that's not all that complicated. And then sometimes prices will move sideways. While I'm doing this, I'm watching pretty much a sideways market now. If you've been watching the daily videos around the time here in the middle of September, we're in a sideways, non-trending environment right now. And that's a pretty big thing to me. That was another real turning point. Okay. And when I was using different forms, welcome, if you can hear me. Okay, as we're waiting for more folks to come in here. So I'm just going to kind of keep going with this. And but that was a big thing for me. It was trying to determine when are we trending and when are we not trending? Because up until that point, and I discovered this in the early 2000s or so, because I was pretty much only using mutual funds to do the program that I teach right now. And I would just be long or short. And if I couldn't really figure out what I was doing, I was on the sidelines. Well, then I started to use the ADX indicator, which has become an important part of my evaluation of the market. And that does a pretty good job. There's nothing that's perfect, but it does a pretty good job of letting us know when we're in a trending environment or a non-trending environment. And as I'm doing these set of courses right now, we're in a non-trending environment. And you notice that people lose interest. I'm not getting as many views on the videos that I post. I'm not getting really any new subscribers on the channel. It's just the way things work out during these kind of boring times as the market figures out what it wants to do. But really, another way to look at that is that the market is experiencing a sort of equilibrium. There's no real forces that are pushing the market up or pushing the market down. Now, there's the gyrations that happen intraday, but we're not really seeing an overall pattern of upward or downward movement as we go into more of a random type of phase. And one of the books that I would recommend is called A Random Walk Down Wall Street. And maybe a lot of you have already been through that book. And it really supports the idea that there's randomness in the markets. And it is, that there is randomness. But then there's another book that unfortunately is a lot more expensive. It's called A Non-Random Walk Down Wall Street. And it takes the idea that you can pick out what's actually happening. And I've kind of come at the midpoint between the two, where there are times when the market's random and there are times when it's not random. And for some reason, my other computer just shut down. Okay. I hope, Jeff, that you can hear me. I'm still seeing little blinky lights coming on. Not sure if you're able to hear this, but I'm just going to keep going anyway. So the question that we ask with support and resistance is, why do prices stop at certain points and then reverse, whether it's going up or down? And unfortunately, we can look at a lot of different things, but it's not always obvious what that point is going to be. And that's what I wanted to address in this particular part of the course. So sometimes this can be explained by support and resistance. Now, there's other times when we just stop at a certain point and go in a different direction. But you'll find a lot of times it'll come down to a moving average, or another index is starting to reverse, or another market is starting to reverse, and that'll bleed over into the S&P 500 itself. So just like most aspects of the stock market, it may not be very complicated to understand about support and resistance, but it doesn't make it easy to figure out, or a skill that you can learn quickly. This is a lot of trial and error, and that's why I try to really point these things out in the daily videos. This could be possible support. This could be possible resistance. And when I'm looking at the different indexes, I also go through there saying this could be support or resistance. What's kind of nice is when we see a real convergence of these points, like right now with the S&P, the NASDAQ 100 specifically, and then the NASDAQ to a degree. The Dow is just kind of treading sideways. We're seeing some weakness in mid caps and small caps. So it's kind of the big, well, really it's the S&P and the NASDAQ 100. And those are the two real drivers. And that's what's been really influential in 2023. But it can take some time to try to figure this out. And as I was saying, I thought at one point of coming up with a list of all the different support and resistance levels, but the list would be so long. And I actually tried doing that for a period of time, and I found myself just staring at the list all the time. I wasn't really getting a feel for the other things that were going on. And I'm looking at gold, I'm looking at oil, I'm looking at the S&P, I'm looking at the NASDAQ 100. And you kind of have to find that balance between, okay, keeping an eye on other things, but at the same time focusing on what I focus on is the S&P 500, because that's the real focal point of what I do. Okay, so another thing is I use specific methods to determine support and resistance levels. And one of the things that I don't do very much is I'm not a big diagram person. Okay, I can see a cup and handle, I can see a head and shoulders top or a head and shoulders bottom, and those are pretty apparent. But when you're going with the pennant and the flag, and personally, now some people may really get those things to work. I've seen them fail just as much as I've seen them succeed. And so I draw some different lines on the charts, and I'll show you some of those. But some of those are more for accenting what is actually going on. It's not a definition of a real trend line. I don't use an awful lot of the other types of patterns that you might see. That doesn't mean that they don't work. I just have never found them useful for me. They're usually dealing with a previous high or a previous low. And then I do use trend lines, and I try to stick with trend lines that fit the textbook definition, where when you're going up, you're connecting a series of lower highs. Is that higher lows? Sorry about that. I always get it confused. You're connecting a series of higher lows. When you're going down, you're connecting a series of lower highs at that point. Because I see some people that I really respect and really pay attention to, and I'm looking at their trend lines going, where in the world did that line come from? And again, I try to remain as objective as possible. That's why I don't use Elliott Wave, because you have to come up with an answer yourself. And I try not to draw too many trend lines, because as I say over and over, you can make a chart say pretty much anything you want it to say.
Ja, ik luister hem, ja.
So, okay, are you there now, Jeff? Can you hear me? Are you there? Suddenly you popped on. Okay, I'm just going to keep going anyway. Okay, so within the S&P, when we're looking at support or resistance, this can be a previous high or low, and I tend to really rely on those. And you'll see some of the charts that I go through when I talk about this. And again, think about the psychology of what's going on at that point. We're coming back up to a previous high. There are people that got in at that high who are just hoping upon hope that they can get back to break even. And so they bought to get in, and they're seeing a loss, and now they're seeing things coming back up to the point where they might be able to get out. And so they're going to be dumping it just as fast as they can. The inverse of that is also true. When we're coming down, there are people that got in, and maybe we're seeing a profit, but now we're coming back down to the point where they were seeing some really nice profits suddenly eroding day after day after day. And that can become an issue too. And so once they get back down to the point where they're at the same price where they got in, they're going to possibly want to get out, or you're going to see other people that are saying, well, I missed this move up, I'm going to catch it this time. And so they're going to get in and start to buy. Also, a trend line, and I really try to stick to the textbook definition of trend lines when I'm doing this. And I suddenly lost my clock. So I thought I was all set up here. The interesting thing is I'm using a different laptop than what I normally do the videos on. For one reason, because of my arm, and for a second reason, I have some power issues. It's a great laptop, but think about this, okay? I'm living in Belarus. It's a Chinese built laptop that I purchased from a Russian puppet in a Russian puppet country, and I'm an American. Okay, what could possibly go wrong? And actually, I had done a lot of research before I went and bought this laptop, but they kind of did a switch on me when I went to go buy it, and I didn't have a chance to research it. It's actually a better laptop than what I was going to buy, but there's three main problems with it. The power cord is what I've really been struggling with. It's very poorly made and it just cuts off, which presents problem number two, which is the battery only lasts about 8 minutes. And then number three is some genius put the webcam at the bottom of the screen. And so I had to go out and buy another webcam to make it more at eye level. So anyway, there, wah, wah, wah. I'm just expressing my poor little difficulties. Now, another thing that we often use for support or resistance are moving averages. And this can be, it can act as resistance when we're going up, and it can act as support when we're coming down. And I use these a lot, and I try to point these out in each day's video. And then you might be familiar with this. It's kind of a derivative a bit of Elliott wave, where we have Fibonacci lines. And Fibonacci was an actual person, and he was a mathematician in Italy, I think in the 12th century, 13th century, something like that. And he came up, he wanted to find out if there was number patterns in the universe that we could apply to trees or to broccoli, or, and through that he came up with these different numbers. And somebody picked up on that a long time ago and said, well, you can try to measure crowd psychology, that some people might have an initial reaction and then things go back in the same way they were. And then they may have a bigger reaction and then an even bigger reaction. And when you recoup and get back to the place where you started, that tends to be an even bigger reaction. And so people started applying that to the stock market to get an idea of what psychologically was happening during those times. And those became Fibonacci lines. And I like them. And because the market looks at them, not because I think they're mystical and have all these answers. It's because there are millions of people who are watching these levels and reacting to them. Now, another one that's a little more new to me is a quadrant level. And I'll show you a chart of this where you take a significant low and then measure to a significant high. The chart that I'm using goes from the COVID low to the all-time high, and then just break it up into 25% chunks. And sometimes these lines are irrelevant, where other times it can act as support or resistance. And I'll give you examples of all these. And then a ratio level. And that's one of the nice things I really like about stockcharts.com is they make it very easy to do ratios. Compare the S&P to the Dow, or comparing gold and silver. And the videos that I do, especially the weekly videos and the intermarket analysis videos, they're just full of these different ratios to see which one is outperforming, or to say it another way, which one is underperforming at any given time. And believe it or not, in these ratios, sometimes we can spot support or resistance within the ratio itself. And it may be a moving average. It may be a previous high or low. I even have some trend lines that I use from time to time in these different ratios. And they're probably not as significant as other parts of the market, but we still want to at least know about them. And I try to point them out in the videos that I do. And then this is another one that even though I don't day trade, I do follow an intraday chart. And I tried all different kinds of charts. I tried a 60-minute chart. When I was day trading, I'd use maybe a 5-minute chart. I ended up switching over to a 10-minute chart, and I realized, this one seems to really tell me something almost every day. And so I just stuck with a 10-minute intraday chart, and I'll show you this. And I use daily charts, of course. And then there's another thing that's really kind of cool too, is the thing called pivot points. And the nice thing about like moving averages or Fibonacci levels or pivot points, we know these levels before we get to them. So we can see them ahead of time and know when price is going up or down, we might be getting close to one of these areas, and we just watch it and see how price reacts as it approaches one of those levels. It might blow through it either to the upside or the downside, or it may actually end up reversing. Just to give an example, it was August, it was a year ago in the summer. The market was really doing well, and I was in some really good positions that were doing good, and I was trying to figure out, okay, on a lot of my positions, I was at my 20% and out thing, but I still had some positions that I was letting run for a while. And then I noticed right above current prices was the 200-day moving average. And at that time for the S&P, we were below it. And we hit that thing spot on and just reversed and started going down after that. Fortunately, I watched that for a period of time, realized, okay, this is going to present some problems. So I started dumping positions, and then we just kept going down and down and down. And within a few minutes, I was completely out at that point. And we knew that ahead of time. And that's the cool thing about this. It doesn't mean it's always going to work out that way, but usually we can get some insight whether we're going to hit a level and turn and go the other way, or if we're going to blow through it. That just suggests that where we were going is even stronger than the support or resistance level that we're dealing with at that given time. Okay, and then supports and resistance levels that are outside of the S&P, which you can look at another index or sometimes a stock. Just a few weeks ago, NVIDIA came out with their earnings, and they just blew everybody out of the water. And they immediately gapped up in the overnight session. And after the market had closed, they reported. And so you had the after hours session, and they were going up really strong. And then they ended up gapping higher the next day. Well, it's one of those buy the rumor, sell the news types of situations where throughout the whole day, even though they had this killer earnings report and looking forward, things were still looking quite positive, but everybody just kept selling. And by the end of that day, NVIDIA ended up being almost unchanged. Well, when you have a really big influential stock like that, it can play into what the S&P is doing and the other indexes as well. Probably not as common. It's a little bit more common in the Dow Jones Industrial Average because there's only 30 stocks that make up the Dow. And if one stock is having a really bad day, the other 29 stocks may be up, but that one stock is dragging the whole Dow down. And that's another reason why I prefer the S&P 500. It's a little more balanced. And then bonds. And that's been what's really been the focus lately is interest rates are going up, which means bond prices are going down. And we start to get to a point where interest rates are creating some problems, and that can end up really putting a lot of pressure on stocks. And then the dollar. Lately, the dollar's been seeing some nice strength. And you notice when the dollar's going up, stocks have been going down. We saw that a lot in 2022. The dollar was really quite strong. And anytime the market was going up, the dollar was going down, or when the dollar was going up, stocks were going down. And I think I said that right. Okay. But they have a tendency to go in opposite directions. And just knowing about this ahead of time can be quite helpful and give you some insight. And then we also, right now, we're watching oil kind of heavily because if you looked at oil from, oh, after the great financial crisis up until 2014, 2015, when oil just kept going up and up and up, the stock market was going up too.
Yeah.
But inflation wasn't really a problem at that time. Well, now we're in a more inflationary environment. So if oil starts going up, that's going to go through to, filling up our cars and all the other things that are involved in that. And it's going to be a lot more inflationary. So sometimes it can be a good thing. Other times it can be a bad thing, which is why we do intermarket analysis. And gold and silver, or pretty much any commodity, probably not pork bellies, or orange juice or something like that. That's more localized in how it might influence things. It's like if you're a fan of The Simpsons, Homer got into the futures market and his broker was on the phone telling him, Homer, I told you to sell your pumpkin futures before Halloween, because he was on a roll as the futures were going up. Halloween comes, nobody wants pumpkins anymore, and the price just collapses, even though there's no such thing as pumpkin futures. Okay, so some guidelines. The nice thing about support and resistance levels is that we know these things are there before they even happen. We don't get a lot of foresight in the market, but this is one area that we can actually see things ahead of time. And then we often see confirmation with other indexes. Right now, we're really focused on the S&P and the NASDAQ 100, and we're kind of keeping an eye on the NASDAQ itself. Where the small caps and mid caps, they're under a lot of weakness. The Dow is just chopping sideways. And we've also been watching the transports an awful lot lately too, but they're now going in the opposite direction and putting some more pressure on stocks. So the big variable that we have to deal with is we're never quite sure which support and resistance level will be influential. And I've had this question asked many, many times. So what's support and resistance for today? And I could give you a whole long list because, yeah, we can look in the S&P and sometimes that's influential, but sometimes we have to look outside of the S&P to really figure out what support and resistance is. So we need to watch all of them. And I wish there was an easy way to answer that, but it's one of those open-ended things that is fluid. It's dynamic. It can change as market environments change. And then what worked one time may be ignored at a different time. If we're screaming up to the 200-day moving average, well, we hit that level in 2022, but when we started to really recover and going into 2023, we just blew right through it. It's like it didn't even exist. So we have to be just aware of that. And the list can be long and become a course of unneeded focus. That's why I don't put up a spreadsheet of all the different levels, because you spend all your time watching that instead of really getting a feel for what's happening in the market. That's at least what I've come to. And we can't try to put the market in a box saying, okay, we're coming, and the financial media likes to do this. We're coming up to the 200-day moving average, or we're coming down to the 200-day moving average. And they love to talk about these things because they're easy to talk about. And sometimes it's a self-fulfilling prophecy, but other times we'll just blow right through it. And to think that it's always going to work a certain way is a mistake. We have to have respect for the market, that in different climates, support and resistance is going to change. So we don't want to fall in love with a particular support or resistance level. We want to know that they're there, and we want to respect them. And when we get close to those levels, we want to watch what's going on, but we don't want to get real dogmatic about it and say, we're going to reverse at this point. The market loves to dole out humble pie. Just about the time you think you have the market all figured out is when everything shifts and suddenly you kind of look like a fool. And because what worked before is not playing out the same way another time. Okay, and I really try hard the best I can. If you watch the videos every day, to point out what I'm seeing as support or resistance levels. And if I miss something, put it in the comments or sending me an email. I try to be real clear about these things, possible area of support, possible resistance. We can only go with a more tentative attitude when we're seeing these things, but just to know that they're there can also be a pretty powerful thing. And I need to keep an eye. Okay. I just want to keep an eye on if I'm going to hopefully not go over the time limit here. Okay, here we go. I have to go through this again. Okay. All right. Okay. So just to give you a very textbook, and I got this I Googled support and resistance, and I came up with this. And we're not really sure, especially when we break new ground. Well, we definitely don't break new ground when we're going down, but when we're hitting all-time highs, it's a lot harder to figure out what is resistance because we've never been here before. Because a lot of times support is largely based on what's already happened, where when we're really breaking out, we don't have anything really to base it on. We use other indicators to try to give us some indication whether we're getting overbought, but we don't know because we have nothing to go against with that. But the idea is that we hit whatever level and then a whole lot of sellers come in and then drive prices back down to a certain point that a lot of times will match a previous point. And then we might go up and then test that same level again, come back down, hit support. And then at some point we also watch volume at these times too. And if there's an increase in volume and we start breaking through resistance, that can be a pretty positive thing. And then one of the key points is what once has been resistance, once we break through it, now will quite often become support. And we're seeing that played out in a lot of different charts that we're looking at. And then we go up and hit a new resistance level and then come back down to support. And we might retest that level. And this is one of the things that really irks me about the financial media. We're screaming up. The market's just doing really well. And you get all these people that come out and say, well, we might go back and test the October lows, or we might go back and test the lows from another year. And then we get down to that point where it looks like we might be testing it. And now the whole market climate has changed at that point. And suddenly what had been positive is switching over to negative. And this blanket statement that is made that we're going to test some previous level, either to the upside or the downside. Well, by the time that actually plays out, now we have a whole other set of things that we're watching because the whole climate has changed at that point. And that's why I'm not a real big fan of buy the dips kind of a thing, because just about the time you pretty much take it for granted that we're going to come down to this level and then start to bounce up off of that. Well, you're going to get in and then we're just going to continue dropping down below it. So, okay. All right. Let's go on to this.
Can you hear me?
Yes, I can.
Yeah. Yeah. Sorry, I jumped in so late. I was
That's
working
okay.
late. I'm still at work. Yeah. But I had someone here and I made a lot of noise. Sorry about that. But
that's okay.
You told me since 1888, it's always been going up. It's pretty much always a bullish market. You have your crashes, but it comes back up.
Yeah.
And so I looked at all of that and I said, Jesus, they have all these things. They tell you how to read the charts. You have the head and shoulders and, all I think, where is this research? But anyhow, I'm going to call it a smile now, because what happened when they gave all that funny money, all the counterfeit money they've made. They call it what is it? Extraordinary easing or something like that.
Yeah, the stimulus money
the stimulus, the funny money.
Yeah,
they're still doing it anyhow. With the deficit, it's all funny money. They don't have it, and they're just inventing it out of the air.
Right.
But since they stopped doing that, it went into a sort of smile.
Yeah.
You see in the S&P. So
Right.
that was by the COVID input of money, and then it just fell off down to the lows in October, and then it came back up, and it looks like it's coming to resistance at that same level. But that graphic that I see now, I never saw since 1888.
Ah,
That
okay.
that big smile where it dips under and it comes up.
Yeah.
Is it going to continue going up? When people, if you listen to people, they say it's going to go, to 6,000.
You're
It's
right.
gonna,
To
it's
the moon.
unending.
Yeah.
Yeah, and but other people say we're going to get a frown now. It's going to
Yeah.
go. It's going to drop under. It is really peculiar times because the patterns in the S&P I can't find anywhere in the whole tracing of the S&P SPX since it
Right.
began the dip here. And yeah, if you think about the fact that America has so much deficit with the interest rates new, they have to pay $1 trillion for air
Yeah.
in
Yeah.
on the deficit. $1
Yeah.
trillion. That's more than they give to those idiots in the Pentagon that are destroying the world.
Yeah.
It's even more than they give to them. Where do they get this money? Well, they invent it from air. It doesn't exist, and they just say, voila, it's there.
Well, and then they
But
turn it into bonds, and if
yeah,
there's no buyers, they buy it themselves.
well, then you have your inverse yield curves that you've talked
Yeah.
about. In Germany now, the 30-year Treasury bill has gone under to like 2.5%. It just
Yeah.
went even lower today, 30 years.
Well, then,
Well,
and before I started posting all the videos, and I did this in some of the classes, both in Germany and then in Japan, we had negative interest rates for a while. We almost got to
yeah,
that point in the US.
yeah. We had a negative interest. They took money out of my bank account
Yeah.
every every quartile.
Yeah, I'm going to borrow money from you, and then in addition to that, you're going to pay me interest. I mean,
Yeah,
it makes no sense.
it was insane.
Yeah.
It is insane.
Well,
But
then
these are rare times.
well, very rare and getting weirder or rarer.
Yeah, rarer.
And
Yeah.
so that's why personally I like the day by day evaluation, because it's long enough to let things play out, but not too long where we're going to get trapped into something. We're going to see something developing where we can get ahead of it the best we can. And
Yeah.
so yeah, I don't know. I don't the big smile, I see that too. And you can make a case that at the beginning of 2023, the logic was that we were going to tank, but the
Yeah.
market just kept going up.
Yeah.
And then and then back in 2021, everybody started putting their life savings into the market because it was turned into an automatic cash machine, and just thinking that it was naturally going to go higher and higher and higher. And then that's about the time when everything shifts and goes in the other direction. And then people are screaming that they got in at the wrong time. And these are not stupid people. They probably sat down, thought it out, applied their logic to it, maybe even asked for advice, and probably thought about it for a while before they decided to do this, and then still got screwed. And
it's like a religion. You believe in the dollar, even though it's really worthless. If you see how much
nothing.
It's backed by nothing, but they believe in it, so it keeps going up.
Yeah.
But if the tide says we don't believe in it anymore, it's going to tank. And the same thing with the market. It's not real. It's false. It has the market and the stocks have nothing to do with the value of the companies behind it.
Right.
It's that people believe in it and they invest in it, they throw money in it, and it goes up.
Yeah.
But if something happens that it comes on the news or something, it can just collapse. People will say, "Oh, it's not good anymore." They don't believe in it. They believe in another sort of religion.
Right. Yeah.
It will just tank. today I thought you would talk a little bit about controlling your emotions, but that's all the market is. It's predicting emotions.
Yeah, yeah, and it has a tendency to overreact, just like people do. And
Uh-huh.
and then, but when we try to use our logic and put it on the market,
It
that can
doesn't
be
work.
one of the hardest.
There
Um,
is no logic. There is no logic behind it.
yeah, yeah. And before
It's
you walked
illogical.
in, there's a random. I was talking about this. There's a random nature to the market, but then there's also a non-random nature. And
It's stochastic.
yeah, and I'm in between the two, where okay,
Okay.
there's times when the market is following what we're seeing in the charts. There's other times when it's like, what in the world is going on here? I can't make heads or tails of any of this. And that's
Well,
kind of where the market's at
where
right
we
now as
are.
we're chopping sideways.
And what is it going to do? It has to go up or down eventually.
Oh yeah, it will.
Who can
We're in a
predict
weak
that?
seasonal time right now. Um,
Yeah. It
we,
should go up now for the rest of the year, actually.
well,
From October to December, it should go up if it follows what you've explained the past years.
yeah, and we do have some real positive things behind us, but now we're looking more at probabilities, and it's an election year,
Yeah.
and but we're going through a time right now seasonally that's a pretty weak time. And September is not, it's the worst month of
It's
the
the worst
year.
month. Yeah.
And even if we get some bounce up from here, historically, September ends up being a weaker time at the end of the month. And then the biggest stock market crashes have all happened in October. And so we'll
Okay.
have to battle through that. And that's why if you watch the daily videos, I'm showing the average of the
Yeah.
VIX
Yeah.
from 1990 up to 2022.
Yeah. The 50. Yeah.
And if we stick with the historical pattern, we might be in for some trouble. But we don't know if we're going to stick to that. You know,
Indeed.
we that's why we just use them as guides, and we want to know about these things, but not necessarily use them to make decisions.
Mm-hmm.
But and so that's why I come out with the day by day evaluation of things, because everything was pointing at the beginning of 2023 that we should be going down, and we didn't.
Yeah,
And
I know.
and then in the spring when we had that nice run up, people are like, well, where'd that come from?
Yeah,
And then they end up
exactly.
reacting to what's already happened instead of seeing things play out as they're happening.
Yeah.
So, but one thing that I found very useful, and I go through this in every video, is the intraday. Within each one of these bars on here is 10 minutes. I found
Yeah.
30 minutes, 60 minutes to be too long. There's other people that might use 120 minutes. It seems to me that one big thing are these pivot levels, and these are known before the market even opens. And, and this is as of yesterday's close. And you can see how
Okay.
close
Yeah.
we've got the daily pivot, and then we came right down. We kind of hit a low right here.
Mhm.
But then you have the unchanged level, which is also a support or resistance level. And then we came right down to S2, which was known before the market even opened. And then we were able to bounce up a little bit off of that. And I found this to be very helpful as far as guides for what's happening. And again, the cool thing is we know this beforehand. And then another thing, and I don't rely as heavily on this. I love the concept behind this chart, but I don't like how it's created. Where over on the left-hand side, this is volume at different price levels. And
Mhm.
if it was more pure based on actual information, I'd get a lot more excited about this. But these lines are only drawn from the price that you see on the chart itself.
Yeah.
And so this can be a little bit misleading. Like when we hit the October 2022 low, look at it, it's like hardly any volume at that level at all.
Indeed. Yeah.
When there in reality there was more of a washout at that time, more of a climactic type move. That's why we shot down like this and then came back up out of that. And so I look at these and I have them on my intraday chart. This is a daily chart here. I wish there was something better than this, but like looking at this volume level right here, well, that kind of matched up with some resistance here. And then we had some resistance before we broke to the upside. So, I mean, there's some uses that you can get from this, but the fact that not all the volume is actually represented over here on the left makes me really suspicious to use this to make decisions. So I like to look at it, but I don't necessarily base decisions around it. And then this is another daily chart with the different pivot levels, because we not only have intraday pivot levels, we also have daily pivot levels. And this is what I post every day on the YouTube community channel tab. I do the daily pivots for each day. I also do the intraday pivots. I post both of those charts. That's the first thing that I do before I even record the video. And these can be helpful just to know what's lying ahead of us. And there's different ways to calculate these pivot points as well.
Okay.
I use what this software uses, but there's a guy named Tom DeMark who's kind of a rock star when it comes to technical analysis. He has his way of calculating these. There's a Fibonacci way of calculating pivot points. There are calculators online that you can use that are free. It's pivotpointcalculator.com. I think that's it.
Well, they're support resistance levels, aren't they?
But yeah. And it's based on the previous time periods, open or not open, but high, low, and close.
Okay.
And that's what a lot of the algorithms are using to make their decisions that do the program trading.
Okay.
These
so
are numbers that, pardon me?
They're predetermined. You can Okay.
And sometimes they're irrelevant, but sometimes they really come into play. We had a big one come into play last July when we look at another chart. In fact, this one. This is a weekly chart where we also have weekly pivot points. Wow. And we went right up to this R1 level in July, and that was the high. We've been battling ever since then. And again, and these are set for the whole month. And so we know that's why watching the weekly videos can be helpful, because we watch, and if I need to, I'll start posting these charts on the YouTube community tab. And you can go back, and the nice thing here is you can go back and see other times that a lot of the time, these pivot points were irrelevant. You know, we just didn't, here they may have offered some support, but then we broke down below it. When we were really going up in 2021, we hit another monthly. This is a monthly pivot point because it's based on a weekly chart. And that was the high at the end of 2021. And then we spent 2022 really having problems. And then it really didn't come back into play until we hit it back this July. I'm sorry, this was December of 2021. And then we hit this again in July. And if we do start going back up, we're going to see, are we going to be able to break through this? And know this ahead of time. But if you're not watching for it, it can catch you off guard. And then the daily charts, and this is where I use a lot of previous highs and lows. I do draw some trend lines here. I try not to draw too many lines on here because it can get hard enough to read as it is. But then even on the daily chart, we have these are standard pivot points that we can use. And that's what we're battling with right now. And notice how the 50-day moving average is at that same level.
Yeah.
So we're seeing a lot of these things coming together. And that's usually when they have more impact. And then when we came down in August, we came right back down to this previous high. So what once had been resistance now becomes support. And we've tested that a couple of times. And so if we do start to fall, Notice we have a support level not too far above where we're at, and we'll be really watching this level. And if it holds, we could bounce up out of that. If we break below that, then now things are shifting a lot more negative.
And
And
that's never happened like this.
yeah, well, I think a lot of it has to do with so much program trading. Because you've got computers that they feed all these levels into, and if A plus B equals C, buy. If A plus B equals D, sell. And so you've just got these computers that just start buying and selling, and that actually makes it a lot nicer for us, because it means that these points are pretty important and we should pay attention to them. And I was somewhat encouraged after Monday when we got a little bit above this pivot point and the 50-day moving average. But then on Tuesday, we fell back below it. And that just shows real indecisiveness right now. And that's why we're in a sideways trend. And then this is another one that a lot of people that trade foreign exchange use this. This is I call it the itchy and scratchy cloud. It's an Ichimoku cloud.
Yeah.
And these are really just moving averages that a price that's already happened, and then they shift them forward. And I don't really see the logic behind this, but because so many people use this, I keep an eye on it. And notice how we came back down into the cloud, and we haven't been able to break out above the cloud. And we have to be a little bit concerned because the cloud after this is red, where green is positive, red is more negative. And so if we start bumping into this red cloud, that could turn things more negative. If we can come up out of this green cloud, that would keep things more positive.
Okay. If computers are calculating A plus B equals C or D, who and what will control what A plus B becomes? Because computers are just seeing something that's already made by somebody else.
Yeah, well, it could be there's other computers that are producing the A and the B part saying buy, as long as we see a series of higher lows or higher highs. Okay. And then you have other computers that are saying if we hit this Ichimoku cloud, or if we hit the 50-day moving average, sell, or buy.
But because someone like Buffett or Fink, they could totally manipulate the A plus B factor.
Yeah. And that's like we were talking about the other night. There are big trading, think about who our competition is. They have almost unlimited money.
They could buy
the smartest people on the planet.
Yeah.
And they can control how this whole thing plays out.
Yeah. They buy and sell countries.
Yeah. And it may not be fair, but if we can latch on and use it to make decisions, we can do the same thing that they're doing. And I'll go months like when we were going up, I didn't even bring this chart up for months at a time because we were so far away from the cloud. But then now that we've been in it, I've been showing it in every video that I do each day. And then eventually we'll go above it or break below it. And I won't talk about it again for a while. And then this is my kind of my own creation, this one. And you weren't here yesterday, but one of the strategies that we talk about are straddles or strangles.
Straddles, yeah.
Yeah, where you buy a call and a put at the same strike price. And this derived itself because one of the criteria that I have for straddles is it has to have a really wide spread between the high and the low. Because you don't want to put a straddle on a stock or an index that's not moving. You may not know what direction it's going to move in, but it has a tendency to really move once it gets going. And so using Metastock, the other technical analysis software that I used for a long time, I came up with this idea of, okay, let's keep track of the open, high, low, and close. But then through that, it developed into this additional indicator that I use in a slightly different way, where when we're above the moving averages, then that's more positive, and when we're below, that's more negative. And then I watch the overall lines themselves to see what direction they're going in. And sometimes, if you notice back here in early 2023, we started hitting a rough patch in the market, and we came right up to this moving average, and that acted as overhead resistance. And then we continued to go down. And then other times when we've been going up really strong, back in the summertime, we were coming down and hitting one of these moving averages, and it became support. And usually this told me that the upward move is pretty strong because it's only hitting the top part of these moving averages. When it goes a little bit deeper, now I'm a little bit more concerned. And notice when we did go deeper back in May, well, we bounced back up, but we pretty much went sideways for a number of weeks there. And so we can get some insight from this. And that's kind of what's happening right now.
Yeah, that's just what I was saying. Yeah.
And we're looking at this, these lines are just flat. They're not moving up and they're not really moving down. And that we're getting confirmation of that from our ADX trend indicator that's also suggesting that we're not trending right now. And so that's why we take all these things together to look at this. Okay. And then I have what it really looks more like spaghetti, but I call it a moving average tree. And there is some method to my madness for plotting both simple and exponential moving averages. And in fact, that's playing out right now as we're chopping sideways. We're right in between the 20 period and the 50 period simple and exponential moving average. Now, which one is more important? I don't know, and I don't really care. But there are people that do base their decisions on these moving averages. And after Monday's session, it looked like, okay, we broke above all of the moving averages, but now we're falling back down below them. And these quite often will act as support or resistance as well. Now, if I was to pick, have you ever heard of John Murphy? The
Sounds familiar, yeah.
Okay, he's kind of the I don't want to say guru, but he was the technical analysis guy. Even though there's been a lot of books written over the years, his books really caught on, and he was one of the original he posts on stockcharts.com every week.
Okay.
And he was one of the guys that got the whole thing off the ground. And he's kind of the head guy when it comes to technical analysis. Well, after the 87 crash, he wrote a really thick book about technical analysis. And he did an extensive study saying, what's better, exponential moving averages, where you weight them closer to right now, or simple moving averages, where all of the time periods day one counts just as much as day 50 in the calculation. And his research concluded that simple moving averages work best. The reason I think that is because they move a little slower, where exponential moving averages move faster. And quite often, if you slow down a little bit in the market, that tends to be better because you're not getting whipsawed as much, where the exponential moving averages are moving quicker. So you're having more of a tendency to get in and get out, where if you had just stayed in, things would have worked more in your favor. So I plot all of these on here, and we look at them. How are they moving? You know, for a lot of 2023, all of these were sloping up. The shortest moving averages were on top and going up. The longer ones were on the bottom. And you could even develop some kind of a trading system around this, where when we're really going higher and this red one is above the blue one, you can ride this wave up. And then when the blue or when the red drops below the blue, you can use that as an exit point.
The exponential is logarithmic. It's the log, is it?
Yeah. Well, what it does,
okay.
it's a weighted moving average where it might count the more recent prices heavier in its calculation. And
Okay.
the first, let's say it's a 50-day moving average, where maybe the first 1 through 10, they don't count as much. Where the last 10, they count more. In how and then you even have the ability to create your own weighted moving average. I haven't gone that far myself. I just use the standard exponential and then simple moving averages myself. Yeah, because that's what most people use. And then this is another one that came up. I actually got the idea for this chart from David Keller from StockCharts.com, where he was noticing these. Okay, we hit the October 2022 low, and then we hit the March 2023 low, and then we just drew a trend line going forward from there. And then we still were above this trend line. So then we hit another low back in May 2023, and then connected that. And then we were really screaming to the upside and have an even shorter term trend line going up. Well, as we started to run into trouble back in July, we broke through the short term trend line. And then eventually we broke through the intermediate term trend line. And we've tried to come back up and test this a few times and even got above it for a while. But now we're down below it again. And the big question is, if we turn and go back up, this is going to provide overhead resistance. And if we really start to fall, we'll be watching to see if this longer term trend line provides longer term support. And again, we can see all these things before they even happen.
Yeah, but this becoming a support, the lower line, that's a lot of guesswork, I think.
Oh, it is.
Really have.
Yeah, it's not very viable right now.
No.
And there's a lot of other support and resistance levels between this price and where the trend line would be if we were to go straight down. But it's still in the overall equation. And because when we were really screaming down in 2022, we were hitting support and breaking support at levels that just a short time before were unthinkable. And so that's why we want to keep these things on the chart. We might never get to that point, or it might be years from now before we do. But we just want to be aware of them for right now. And it was looking for a while that this intermediate term level was going to hang in there and provide support. And we came right down to it. But then as things turned even weaker, we broke down below it. And then we've tried to come back up to it a few times and have not been able to really clear that. And that's part of the guesswork of what we're doing. And lately in the videos, I haven't even been showing this chart because we're out in no man's land as far as this is concerned. So why bring it up? And there's other charts that I haven't been bringing up lately too. And then a nice thing about this is with the NASDAQ 100, we're also dealing with, well, this had been resistance. We broke above it, then it became support. We broke below it. Now we're coming back up to it, and we're right on it right now. And this is also going back to a previous high. And you notice that a pivot point and a moving average are all right around the same point. So when we see these real convergences of different tools that we use, that means it's going to be pretty significant. And until we can break back to the upside or we're going to break to the downside, I think that's why you're seeing a real indecisive market right now too. And then we also, here's some Fibonacci levels that I've been watching. And I don't think this is remaining as important as it was in the past. because we're kind of blowing through this level without really slowing down. We got above it, and then we broke below it, then we got above it, now we're breaking below it. And so this may become less relevant. And plus the NASDAQ is a much bigger index, and this is mainly smaller companies, where the NASDAQ 100 is the bigger companies that really drive the market. But we still want to know about these things. And, it's just, well, you wouldn't have seen this until you were after the fact. If we went from the NASDAQ all-time high to the October low, we hit this level, but we wouldn't have known that because we didn't know what the low was going to be. But when we were coming back up and retesting this, notice how we didn't just blow right through it. We hit this level a few times before we broke through it. And if you're long some strategies and you've been going up right here, you might want to start taking money off the table right about here, because you're not really sure what's going to happen after that. But then if things break through it, okay, you've already locked in the profits that you have. And now we shot immediately up. And this was a very influential fib level at the 61.8 before we backed down. But now as we're chopping around, well, let me point this out again, where we came back down to the 50% level, and that marked a low in August, when we were having a lot of difficulties. So, and it's not that these are magical. You've got all these algorithms out there. You've got millions of people watching this all at the same time who see this and make decisions based on this.
Mm-hmm.
And then this is longer term, where we're going all the way back to 2009. This is a daily chart, but and what I tried to do is connect some highs here, and then I drew a parallel line, pretty much matching the COVID low, and we maintain more of a positive stance as long as we're above the midpoint. And I usually only talk about this chart in the weekly video, but if we come down and break below this, where we did do that before, so it doesn't mean the end of the world, but if we do start to come back down, we're really going to take notice of that. But we're not really sure at this point because we're far away from that line. And then this was a big one. And I remember pointing this out in the weekly video, where here is the R1 level here. We came right up to it in July, and we've been really having a lot of trouble ever since then. And then we also hit one of these pivot levels right at the end of 2021, which is right before we went into the monster year of 2022. So, and we know these things beforehand. I keep saying that because I'm amazed at this, that there are a lot of unknowns, but there's a lot of knowns, and these pivot points are here now. And if we come back up and try to hit this again, and if we break through it, that's going to turn everything a lot more positive. But then there's other times when we just blew through these levels and it's like the market didn't even care.
Yeah.
And then this is a very long-term chart. This is a 200-week moving average, not a 200-day moving average. And this goes all the way back, if I was to extend it back to like 2002, I think it is.
Uh-huh.
And then when we were really having difficulties back in October, just about a year ago, we actually came down and broke below this. But then we had another 50% retracement level that we were able to close up off of that, and then start to see some real recovery from here. And this, for right now, looks like it was the bear market low. And now we're far away from that. So I show this in the weekly video, but really just to say that it's not telling us anything at this time. But it sure was back in 2022. We were getting a lot from this chart. And we were seeing, really, when I started to notice this was when we hit the 50% retracement and the 200-week moving average were all converging. It didn't happen that way, but I was really wondering if we were going to come down and hit right here.
Mhm.
but we were able to bounce up off of that, and when we tested it later. So let's see. I think this is, yeah, this is the last chart, and I lost my clock. I don't know what time it is right now. Oh my gosh, I've gone overboard here.